All right, so today is Wednesday, August 16th. This is the week 6 session, home stretch for the class. Before we kick off today, does anybody have any questions or comments about anything to address?
Maybe if you can share more details on the exam, which I imagine you will.
Yes, that's going to be, we'll cover that here in just a second. Anything else? All right, so based on that question, let's go ahead and kick off and talk about some very important logistics for our last week of class. So go ahead and share my screen. So a few things. Next week, two big things are going to be due. You finished all your individual homework assignments. But basically, there's going to be the week 17 presentations, which we'll talk about just in a minute. And because the exam question was asked, here is the final exam. I will post the final exam sometime tomorrow, make an announcement that it's available, and you can take it anytime between then and August 23rd, which is basically next Wednesday's class before the class starts. Okay. The exam will be a 10-question multiple choice exam. So it's relatively easy to grade. And essentially will be auto-graded when you submit the answers. And essentially it's going to cover the content side from the book and what we've talked about in the class, although probably not going to ask a lot that's in the book that we didn't talk about in class in terms of the questions on the exam. The exam is open book, it's open notes, it's individual, obviously no sharing amongst each other, so you can't collaborate on the exam, it's an individual exam, but it is to some degree cumulative of the content across the 6 weeks of the class. Okay, so an example question might be something like this. What is the appropriate amount of time in an enterprise DCF to forecast year by year before entering a continuing value period? 3 years, 5 years, 7 years, 10 years, none of the above. So what would be the answer to that question?
5 years? I hope I'm right.
That would not be a correct answer, unfortunately.
Isn't it? It depends on the type of company and if it's reached maturity.
So what would your answer be then?
None of the above.
That would be the correct answer. So, so that's the point. Like we talked about this in class, and I think this was also referenced in the book, but I think your comment was correct. Like it really kind of depends on where the company is, because you want the company to be sort of mature ideally when you get to continuing value. Now in this class, we've arbitrarily picked 5 years. I was very clear about that just for simplicity. But as I said, you take a company like, Google or even Tesla, you're probably going out more than 5 years before they're in sort of a stable, steady state. And so you'd probably want to forecast year by year at that point in time. The other answer would be that if you're dealing with a cyclical business, you want to make sure that you capture the entire cycle in your year by year forecast so that the final year doesn't just arbitrarily end up at the top or bottom of a cycle, because when you get into perpetuity, it's going to cause you some problems, right? But the short version is it would be none of the above. So those are the types of questions that you're going to get. As I said, there'll be 10 of them. It's going to all be multiple choice. Hopefully not multiple guess. So take the time to reflect back on your notes if you need to before answering the questions. But that's going to be the final exam. And again, it'll be due next Wednesday, 5 p.m. before the start of class, individual exam. Adam, you got your hand up?
Quick question. Is there going to be a time limit on the final?
I'm going to set a 4-hour timer because I do want you to take it all in one sitting. Like, I don't want you to kind of like take it piecemeal throughout a week. So when you're going to take it, take it at one time. I will put a 4-hour time limit to submit, but it shouldn't take you 4 hours to answer 10 multiple choice questions. Great question. Any other questions about the final exam? Hopefully pretty straightforward. Again, that's going to be worth 20% of your semester grade. So you can think about that as each question will be worth 2 points. All right. The other thing that's going to be important for next week are the team presentations, which is 40% of your grade. And I got a question from somebody, and I thought it'd be useful to post an announcement. So I put in the announcement as well here in the link for the team presentations. So essentially we have, and everybody's on a team now. So let's go back here. These are the 5 teams. Okay. Each team presentation will be 30 minutes of time. Okay. So your group will be presenting for 20 of those 30 minutes, or up to 20 of the 30 minutes. And then the final 10 minutes is for one of the other teams to act as a sell side analyst and to basically ask your team questions relative to the content of their presentation, have a little dialogue Q&A. Okay, so I'm staying out of it. I'm not going to be asking questions of the team. It is your peers that will be asking questions of you about the various aspects of your presentation. So 20 minutes of you presenting, 10 minutes at the end of that, so they're not interrupting you throughout your presentation, the Q&A period of your peers. Okay, now that's going to be very relevant because the peers are part of your grade, right? And they're also going to be graded on the fact that they're doing a peer evaluation, the sell side analyst. So if we go back to the syllabus, way it's going to work for grading is, I think here I called it the investment committee. Okay. And in the syllabus, I originally said 5 minutes, but since we only have 5 teams, I'm going to expand it to 10, up to 10 minutes of Q&A. But essentially what's going to happen is you're going to do your 20-minute presentation. Another team, which we'll assign tonight, will be your investment committee / sell side analyst. That's going to be evaluating your presentation grade, and your grade, which is worth 40 points, will be broken out into those 4 components. 70% of your grade is me grading your presentation. Okay, the 4 sections of the presentation, which we'll come back and talk about. 10% will be basically the quality of the presentation itself. Okay, so 70% is based on the content, 10% is based on the way that you present that content as a group, and 10% will be the investment committee's view of your presentation. So basically you're going to be grading the other team and on a 10-point scale, and basically you can assign them up to 10 points if they do a great job, 0 points if they do a terrible job. So essentially you're grading them as well. And then I'm also going to be evaluating you on your teamwork. Like, did you work together collaboratively in the presentation? Okay, so 70% your content that I'm going to grade, 10% how well you presented, 10% did you work as a team in presenting it and answering the questions, and 10% is your peers evaluating your presentation on a 0 to 10 point scale. Okay, so that's going to be your grade. So what's going to be important to make sure I get your final grades in for a letter grade as we near the end of the semester is that basically I'm going to give you 3 days. So basically by Saturday, your peer review investment committee role, sell side analyst grade, and write-up of what you thought of the presentation that you were assigned to evaluate needs to be submitted. Okay. So there'll be a link for that. I haven't posted it yet, but you'll post to that link your peer evaluation of that team. So before we go through the specifics of what needs to be in the presentation, is that clear? Any questions about that?
So you may have pointed this out, but I'm sorry if I missed it. Is the peer review, it's a team assessment of another team or it's individual assessment of another team?
Team to team. So to be more specific, and I'll post an announcement about it, but it's going to be pretty straightforward. You're basically going to evaluate the team above you. So for example, Tesla is going to be presenting for 20 minutes, and the team of Planet Fitness is going to serve as the investment committee / sell side analyst role for the Tesla presentation. So at the end of the 20 minutes, Planet Fitness will have 10 minutes to have a Q&A with Tesla about what Tesla said in the 4 sections, asking them a Q&A about the content. Okay. 3 days later, they're going to submit, within the 3 days, Planet Fitness is going to submit a grade 0 to 10 of Tesla, how they think they did in the presentation, the Q&A, and their rationale for that grade. Okay. And that's going to be 10% of Tesla's grade. Okay. Planet Fitness is then going to present for 20 minutes. Home Depot is going to serve as their investment committee. Okay. So basically Home Depot will ask Planet Fitness, same thing, questions, Q&A, 10 minutes. And then within the next 3 days, they're going to submit their grade evaluation for Planet Fitness. The Home Depot team will, for 10% of Planet Fitness's grade. Disney is going to be the investment committee for Home Depot. Qualcomm is going to be the investment committee for Disney. And Tesla is going to be the investment committee for Qualcomm. Okay. So again, I'll post this in an announcement, but if you just, generally understand the structure, that's how it's going to play out. Does that kind of answer the question?
Yes, thank you.
Sure.
So just one submission for the team evaluation for the whole team or each person on the team?
No, one on behalf of the team.
Okay.
So
And
basically the Planet Fitness team as a team should do a write-up of the evaluation of Tesla. You're submitting it as a team.
Gotcha. And how long should the rationale of why you're grading them that grade be?
20 pages. I
Nothing.
think I think realistically, I'd expect about a page. I mean, I'm not looking for a page or so. I mean, it's just basically, how did you think they did in their presentation? How did you think they did in the Q&A? If you're evaluating them, did they kind of address the issues that needed to be addressed from your perspective? And how they respond to the questions that you asked in terms of, do they know the business? So again, I think the important part, and this is going to be part of your 70% as well, when we get into the grading, is I don't expect, and again, picking on Tesla for a second, that Tesla is going to be a pure clinical presentation. Right. And so here's what I mean by that. I don't expect you to just talk about numbers. Like, you should be talking about what's going on if you're doing your EIC with the automobile industry. Okay. You should be talking about when you're doing your valuation, like what's going on in those bull bears that are tied to the automobile market. You should be talking about what's going on when you do your historical analysis about why some of those changes might be happening to Tesla, right? As opposed to just, it went up by 3%. Okay. So that's what I mean by it's not just a number evaluation. There should be some context in that 20-minute presentation. And so that's part of what Planet Fitness would be looking at for Tesla as an example. Questions about that?
Should we just email our evaluation or write up to you? Or is
I'm
there
sorry?
should we just email our write up to you, our evaluation of our team, or is there something to submit it?
What I'm going to do is I'm going to add another assignment, just so it's convenient. So you're not sending me a bunch of emails, to basically submit as a team the evaluation. So it'll be listed here in the assignment section. So I'll put it there. Haven't done it yet. But you're not even going to be writing this up until after next week's presentations.
And it's one per team, correct?
One per team. So the whole Planet Fitness team is basically evaluating the Tesla team. We don't need 6 different evaluations. You're just evaluating as a team.
Are we evaluating our team members too? Is that due the night of the presentation or is that later?
I'm going to give the same time period for any peer reviews.
Cool.
So 3 days after the presentation, there'll be the link for the peer reviews for your team members. For that peer reviews. So basically, did everybody equally contribute to the effort of creating and presenting the presentation? If you did, it's gonna be a pretty easy peer review. If you didn't, then in the peer review, just put in a percentage of the effort and a rationale why. Hopefully that's not an issue with any of the teams. All right, let's talk about the actual project presentation. So it's either in the announcements or it's in the assignments. But here's the idea. Again, the presentation is going to be a PowerPoint. There's no paper that you're going to be submitting. You're going to be submitting a PowerPoint. However, everything that you want to present needs to be in that PowerPoint. And I do that out of fairness to the other teams, because whatever team goes first, another team might realize later that like, oh yeah, we forgot to talk about that team talked about that was important. So I don't want you to just say, oh, we didn't put that in our original presentation, so I'm going to go to another file to show this extra information that I forgot to put in. So during the presentation, I'm only going to grade what's in that PowerPoint. I'm not going to accept any data or analysis that's not in that PowerPoint when you're making your 20-minute presentation. So it's an important rule for all of the teams out of fairness. And you're going to submit that PowerPoint that you're going to be presenting. I think I put in at 6 p.m. before the class starts. So between 6 and 6:25 next week, I'll download all 5 presentations. I'll have it in front of me while you're presenting. And that's the data that you're going to be presenting, right? Now, you're also going to submit, in addition to your PowerPoint, you're going to submit your 4 Excel files, your target, your as is, your bowl, and your bear. Okay. Now, here's the other thing. When you're talking through the scenarios for the target, the as is, the bowl, and the bear, the key data needs to be copied into the PowerPoint. Okay. So as an example, I would recommend, and I can give you a sample PowerPoint presentation from a team in a past semester that I think did a good job if you want to use it as a reference. But basically what teams have in the past done is they've taken the screenshot of the ratios and the assumptions tab. And so imagine 4 slides and 4 screenshots. So they say, here's my as is, here was the assumptions, here was the ratios that I changed, a couple bullet points explaining it, and then that was the share price. And then they just repeated that through the bowl, the bear, and the target. So it was really easy to follow along why they were changing, what they were changing, and what it led to the results. Those are the 2 key screens. So the point is those screenshots would need to be in your PowerPoint. So I don't want you jumping to the Excel file to basically show me something that you forgot to put in your PowerPoint. That will be graded down. Okay. Now I still want you to send me the Excel files. I might be looking through them. But for your purposes of your PowerPoint, everything in the PowerPoint next week as I go through each one of the 4 sections. So that's where the screenshots should be showing up. Okay. So assuming 20 minutes, that's approximately 5 minutes for each of the 4 sections of the course that you're going to be going through. Now, I will tell you that it has been my past experience that people take longer with EIC than any of the other sections. So I strongly recommend over the next week that you practice as a team and that you don't just show up not practicing, breaking the project into 4 pieces and doing it for the very first time, right? Because that will probably lead to challenges with your grade, because 2 things are going to happen. One, I'm cutting you off at 20 minutes and starting the Q&A period. So everyone has 20 minutes, right? And so if the EIC section goes really, really long and you don't get to the multiple analysis because you ran out of time, you're going to lose points regardless of whether it's in the PowerPoint presentation or not. So very important that you cover all 4 sections, okay? Even if one section takes a little bit longer. And then the other thing is when you do this, breaking up the presentation, so distribution of labor for efficiency, make sure that you don't contradict each other across the sections. Because though I might chuckle, it's still going to hurt your grade. Okay, so you can't have the EIC people talking about the future 5 forces being miserable for the industry, and then your DCF valuation looking like the bull is your target, talking about all the sunny skies ahead for the company. Like, that's just not going to sync up. So there should be a storyline that goes across these four presentations, four parts of the presentation. And you should not contradict each other across the sections. So I will be looking at consistency of data as I'm listening to your presentation. Okay. So a couple of tips and tricks as you get started. The other thing is, because it is a team grade, it is up to you who's presenting next week. Whoever's presenting is presenting on behalf of the team. Whoever's answering questions in the Q&A is answering on behalf of the team. You're going to get a team grade, but it's very important from my perspective to looking at teamwork and your perspective and your peer evaluations to basically say that everybody participated equally in that process. So you can decide what that means in terms of who's presenting and who's answering questions, but you're a team. It's not just one person doing all the work and one person doing all the presentations. That shouldn't happen. And again, I'll pause for questions about any of that.
Yeah, could I ask one question about the time? So obviously we don't want to go over 20 minutes, but if we're like 15 minutes long, is that going to hurt our grade or not?
If you can accomplish all the data in 15 minutes, that won't hurt your grade. Just make sure that you're covering what needs to be covered.
Okay, great.
It's just for fairness, I'm holding everybody to 20 minutes. So that way I can't have one team go 25 minutes and everybody else go 20. And then, because again, with the 10-minute Q&A periods, plus the class would end. we'd run past our class time, because five presentations, 30 minutes each, a 2.5-hour class, and a couple breaks in there. So we're looking at a long week next week anyways. All right, let's talk about the content for each of the sections. I want to talk about 4 sections.
Right, can I ask a quick question?
Sure.
So just to clarify what you said, we're just submitting, we're giving our presentation next week, but we're just submitting a PowerPoint and our Excel files. There's no write-up or paper with it?
Correct.
Okay.
So you're going to be graded on what you say and what you submit in the PowerPoint.
Okay.
And by the way, they need to be, from my perspective, both. Meaning, if it's in the PowerPoint and you don't talk about it, I can't give you full credit for it. And if you talk about it and there's no corresponding data in the presentation to reference what you're talking about, I can't give you full credit for it. That's what I mean by going outside the presentation. So if you forgot to just randomly, oh, I forgot to put my target evaluation into my PowerPoint. Like, even if you're talking about a target evaluation and it's not in your PowerPoint, I'm not going to give you credit for having a target of valuation of the company. Okay. So the screenshots of the ratios, for example, and the assumptions for the target and a price needs to be in there. Same thing. If you don't put in a buy, sell, hold opinion, you forgot to put that slide in. You can't just start riffing on a buy, sell, hold opinion based on your target valuation. There should be a screenshot or a PowerPoint page that says this company is a buy with this price target. Okay. So that's what I mean by it needs to be in the presentation when you're talking about it. Back to the 4 sections. Approximately 5 minutes per section. I'm just taking 20 minutes and dividing by 5 or 4. But the first section is EIC, similar to your EIC homework assignment. What's going to be relevant there on the screenshot side is you should have in your PowerPoint the screenshot of the RV beta, the markets beta, talking about the for economy, industry beta and company beta, to talk about economic sensitivity at a minimum. You should also have the spread screenshot in there to decide whether or not this is an attractive industry or non-attractive industry today. Your team should be doing a current 5 forces to explain that spread. And you should talk about the 5 forces in 5 years, whether they're changing and what it means to the industry spread. Then for the competitive advantage, you should go back and refer to the screenshot as to whether or not the company has competitive advantage today, yes or no, and why, and what's going to mean for 5 years from now for the company's competitive advantage and relative spread in the industry, and whether they're going to have one and why or why not. That's what you should be covering in the EIC. Okay. For the second section, the historical analysis, you need to basically walk through the ROIC tree, 5 years, both levels, level 1 and level 2. You need to talk about the key drivers, any key numbers that are popping up in between years that are relevant to the changes in the 5 years. And you should have some real world context if anything happens. So for example, you see a big jump in goodwill in year 3. It's pretty obvious that there was an acquisition there. Like, you should know that there was an acquisition and who they bought. Okay. And that gets back to the teams that are going to be asking you questions during the Q&A. Like, they should be looking at this data as well. And if you didn't talk about it and they see a big change in a number, they should be asking you about it. And you should be able to tell them why those numbers changed in the context of the real world, if there's a big change in those numbers that you're showing. Okay. Same thing with the CFI. Yes, you can total up the 5 years, but make sure you cover the 4 sections of the CFI. What's happening with gross cash flow? What's happening with gross investment and free cash flow, starting with free cash flow? What's happening with non-operating cash flow? What's happening with debt and equity cash flows? Okay. And again, any big nuances over the 5 years. Then you would get to your enterprise DCF valuation, of which you have done 4. You would have done an as is. You would have done a bull, a bear, a target. You'll talk about the key numbers you changed and why you changed them for each of those, leading to that final share price, and then the buy, sell, hold that would come out of your target valuation relative to the current share price of the company. And then the final section will be down here, where you'll be talking about the multiples. Okay. And again, I'm going to give you data on 2 other companies besides your own. So I put it in the wrong place a few minutes ago, but I was starting to grab some of the data tonight. So for example, in the file section, under week 6, which is not in the right place, it should actually be under your team folders, but I put in the data for Tesla. Okay, so Tesla is going to compare themselves against BMW and Ford. So those are the 2 automobile peers, in addition to Tesla, that they're going to do their multiple analysis on. So relative to PE, relative to the EV to EBIT multiple and the EV to revenue multiple, basically, why is Tesla trading at a premium or discount? Pretty obvious it's going to be a premium to BMW and Ford. All right. And what were the rationale for all of that? So basically, that's going to be the 4th section. Okay. 20 minutes, cover those 4 sections. Once you've gotten to that point, then it'll be up to the other teams to then do the Q&A. So we get to the 20-minute point. I'll then say, all right, your investment committee sell side team can start asking questions. So the Planet Fitness team would then be responsible for then asking questions to Tesla, and 10 minutes Q&A, and then that would be it. And we'll move on to the next team. That's pretty much how it's going to run. I know, again, that was a lot really quick, but hopefully pretty straightforward. Adam?
For Disney on the RV screenshot, I didn't see the beta, a column for the betas. I was able to find the beta on a different screenshot, but it doesn't have the peers. Would you be able to add that column and repost it?
So two things. I need to put in the rest of the data with the multiples for each of the teams. And if I missed any screenshots, which it sounds like I might have, like RV markets beta for each of the teams, check Disney, then I will also put in that screenshot as well. I think I just forgot to put it in for all of the teams, not just Disney. So everyone's going to need that screenshot as well. And what he is referring to, Zoom, is if I go to Disney. So I've given you the spreads. What I think I forgot to give you last week, and I'll need to make sure I give to you so you can do it in the E section, is this screenshot, which has the industry beta as well as each of the betas for the companies. So that's the screenshot I was referring to that I need to upload, and I'll probably do that this evening. And the second point I was going to make is we're not going to take the full 3 hours of class tonight. when we finish our content, probably in the next 45 minutes to an hour, I'm going to give you the rest of the time as teams to work on your projects. And I'll be hanging around to answer questions if you want to stick around while you're working on them. So just FYI as well. All right, Chris, got a hand up?
For the ROIC trees, Professor, you don't want sort of competitive analysis there, like you're not giving us data to get into, the last 5 years of ROICs for the 2 or 3 competitors that we have. We're really just doing that. We're really just getting data just for the multiple section.
Yes. If we had to some degree more time, I think that'd be a great analysis to do. Like put your ROIC, for example, of Disney against the ROIC tree of Fox and Paramount and see how they changed over 5 years. I think that would be a great supplemental analysis. But for purposes of what we're doing for next week, I'm not requiring that part. The only one that's going to be a evaluation against peers is going to be the multiples. Right? So the DCF is just Disney. The historical is just Disney. The EIC, you're kind of talking about the industry there because you're talking about the 5 forces. But the data itself is going to be off the RV markets and the industry spread. So that one's a little bit more, but you're not getting into what's causing those spreads to change over time. It's just limitation in the interest of class. But good question, good point. Other questions? Hopefully, again, pretty straightforward. What's being required? All right, so the plan for the rest of the data, and you can kind of get a sense of this with the Tesla team, or I'll just move these files back here. But the remaining files that you need to do your analysis, I'll be posting tonight. Okay, as I said, I think we're going to have a shortened version of the class. I'll be around to answer questions, but while I'm around to answer the questions, I'll be copying and posting all the data that you need for each of your teams. So you guys will have all that ready to go. And then if you do need any other data or have questions about something, obviously reach out to me throughout the week, and I'm happy to go either try and grab some stuff or point you in a direction to get it, if you think it'd be helpful supplemental information beyond what I gave you. So that would be what I would call our end of semester logistics. These semesters go by fast. Only 7 weeks long. All right, any final questions about that before we talk about our week 6 homework? All right, so let's go ahead and talk about your homework assignment. So for this week, it was on the social media online search companies. So we had, give you Meta, Amazon, and Google. So why don't we start out with somebody, put up your spreadsheet and start talking about the PE analysis. It'll be kind of good practice for us going into next week. So who wants to start off by sharing your PE analysis?
I'll go.
Okay, thank you.
So this is our PE analysis sheet. This was the information we were provided. Obviously, it was helpful to keep that pasted in the sheet, but this is the.
You got to share. I don't think you got to share.
Am I not? Oh, you're right. Sorry.
It's okay.
Is that better?
Yeah, it just came through.
Great. So yeah, these are the. This is the information from Bloomberg that we were provided.
Mm-hmm.
This is the core of it.
All right, so why don't you talk about the PE premium or discount Meta versus start with Amazon?
Sure. So obviously, Amazon's trading at a premium to both. The confounding factor there is obviously Amazon is more than just a tech company and not exactly a social media company. So as far as comparables go, there are complicating factors. But they do have higher expected future growth, so the premium makes sense.
Now, if I'm grading you, I'd like you to be more specific about the numbers, because there's some reasons that the numbers are causing them to be more high premiums. So can you relate that, or can somebody help you relate that using these numbers? Like why 46 versus 18 at Meta as a PE?
Sure. So I mean, they have a much higher expected continuous growth rate than either other company, despite having a slightly lower ROE and a lower spread. That's enough to make them trade at a higher premium.
Okay, so imagine that there's a lot of data on the screen and it's hard for me to follow all the data points that you were looking at. So can you restate that using numbers so it's easier for me to follow along?
Sure. So their expected future growth is nearly 50% higher than either competitor at 11.04%, as opposed to high to mid sevens for Google and Meta.
Okay.
Their spread is lower at 5.2%, which is less than half of their competitors. They have a lower ROE at 17%, as opposed to 20 and 25% for their competitors. And their cost of equity is the highest, but again, their growth rate is what's driving the higher premium.
And when you synthesize all of that, why 46 PE? What about what you just described leads to the 46 PE?
I wish I had a better answer.
Okay, we'll let you phone a friend here. Somebody else want to try and help them out? What causes Amazon to have such a high PE of the numbers that he just listed? The way?
So I think it's their minimum. They have a really low spread between their cost of equity and their growth.
But shouldn't a low spread lead to a lower PE? Like all things being equal, if my peers had higher spreads than me, they would have higher PEs than I would. So why is Amazon trading at such a premium? Yep, added to.
I would say it's mostly because of the growth rate. Because if we change the growth rate of Amazon to 7.61 to match Meta, their P is going to reduce to 12.51.
Yep. So it is the G. All right. Who made that change? Did you make that change, Patrick?
Yeah, I did.
You're the one? Okay. Can you undo it and switch it back?
It's back to original, yeah.
Okay, thank you. Can you just do this for me as a favor, since you have your spreadsheet open? Go to F3. Go to cell F3.
Sorry, I lost everything there for a second.
Go to cell F3, or F4 is fine, and put in 0.2.
It's like he froze.
Oh, you might have frozen. Are you back?
Sorry, I'm back. I froze there for.
In F3, put in 0.2. And in F4, put in 0.17.
Sorry, I'm dropping in and out here for a second. I'm
That's okay.
still
Stop
Yeah,
the
so-
sharing. Okay. So here's what I was going to ask him to do. I'll just start out with a blank Excel file. And I should be sharing this. All right, 0.2 and 0.17. What are those two numbers for everybody's benefit? What's 0.2 and what's 0.17? Based on this assignment, based on the screen that was just in front of you.
ROE.
That was the ROE of each of the companies. So an ROE of 20% is 20 cents per year. An ROE of 17% is 17 cents per year. Okay. So all things being equal, 20 cents is worth more than 17. If I'm just doing it $1 of equity, assuming growth doesn't matter. Okay. Assuming cost of capital doesn't matter. So 20 cents is worth more than 17. Therefore, on a dollar basis, the company with 20 cents should have a higher PE, right? But as we said, growth comes into this because the growth rates are not the same. So what is the growth rate of who had 20%? Meta? What's their growth rate?
7.61.
7.
Okay, we'll round off and say 7% for simplicity. So here's the point. Equals that times 1.07. So what does 20 cents go to? Next year, it grows to 21.4. Now here's what I'm going to do. What does 17 cents grow to? How fast is Amazon growing? The 17 cents?
11.
So times 1.11. Next year, 17 cents grows to 19 cents. Watch what happens over time. When you get out here, and we're not even in perpetuity, because this is a perpetuity, notice that the company that started with 17 cents is now worth 73. And the company that started with 20 cents is now worth 51. This is what I mean by it's the growth spread combination. So that's the point. You might have a lower spread, Amazon, but when you compound it with a much higher G, you lead to a much higher value. That's why they're trading at a PE of 46, because it doesn't just stop here on year approximately 15. It's going to ... into infinity. And that's the whole point of a perpetuity. Okay. So when you go to perpetuity, the company that has the much higher growth rate with a positive spread is going to be worth a lot more. It's the growth spread combination. That was key value drivers. This is just mechanics of what we talked about in key value drivers in week 2 of the class, weeks 1 and 2. But that's the point. Like Amazon is trading at a premium because they have a slightly lower spread than the other two companies, going back to the data. But they have, so I'm going to go ahead and stop my sharing. So Patrick, can you reshare your Excel file? Are you able to do that? Patrick, are you still there? Did we lose you again?
Sorry, I missed the question.
Can you reshare your Excel file?
Oh yeah, absolutely. Sorry about that.
So tell me why Google is trading at a premium to Meta.
Google's premium to Meta is because they do have a higher ROE and Meta's G is not high enough to beat Google's higher spread.
So Google's higher spread, 19.7 versus 18.2, is because of what again?
Because
Sorry, I think you cut out there a second.
sorry,
Yeah, go ahead.
they had the higher ROE and the lower cost of equity.
So for Google trading at a premium to Meta, even though Google's growth rate's lower, it's because Google has a higher spread than Meta, about 14 points versus about 9 points, and a slightly lower cost of equity. That's what's causing Google, when you do the key value driver math, to trade at a slight premium. Okay, so they're trading a premium not because of the growth, they're trading a premium because of spread and a slightly lower cost of equity. That's why Google's trading at a premium to Meta. Okay. And as was said at the beginning, there's a little bit of an apple and orange here because Amazon's growing for more reasons than just social media, but nonetheless, as a company, it's the Amazon growth rate that's really differentiating their PE. And all of these companies have pretty high cost of capital. Is that clear to everybody? And by the way, this is what you need to be talking about next week. You need to be using numbers. You're going to be referring to numbers. And I'll give a good example of this. When you're doing your preparation, okay, and I know it's going to sound a little hokey, but I would like for one of your team members to close their eyes and listen to your presentation and see if they can follow what you say without seeing the data, right? Because that's what's important. Because, and this is real life, but what I'll tell you is that when you present a bunch of numbers in a PowerPoint file or an Excel file on the screen, you see what you're looking at, but no one else in the room sees what you're looking at. And it is a good skill to not only show them what you're looking at by using the numbers, but it helps them. Because if I just see like 50 numbers on a screen, I don't know what you're looking at. And I don't know which numbers are most important. So it's much more helpful if you can tell me what's important by using the numbers so I can follow along, or at least have some sort of like highlighter or something. We don't have that here in Zoom, but that's what's going to be important next week. So again, if I can't follow your numbers, that's why it's important that I feel that you use your numbers. It's going to be hard for me to understand your vague statements, because you could be making a vague statement about the wrong number and just be right about your vague statements. That's why numbers are so important. Joseph?
At what point is a PE value too high? So it's like an overvalued company.
Well, the answer is, that'd be a good multiple choice question, by the way, for next week. So how about, instead of me answering it, how about somebody else answer it first? What would cause a PE to be too high?
I mean, I would say if it's speculative growth, if there's not true growth potential.
Put that in the context of the key value drivers. What would that mean on this screen? Stephen?
Wouldn't it be if the G exceeded the cost of equity?
That can't mathematically happen, so that would be one potential answer. But I think there's a more practical answer in the answer to that question. What would cause Amazon's PE to be too high? What would make Amazon's PE appropriate? Adam?
Well, Amazon's main driver to their high PE is their perpetual growth rate. So I would say that if that was too bullish.
And if the growth rate were not 11% into perpetuity, it were 9% into perpetuity, what would happen to the PE?
So it would nosedive.
So that's the point. That's the answer to the question. Meaning, if these numbers are going to come true, then Amazon is appropriately valued, and the PE is not too high, right? What would make a company's PE high is that people have it wrong. They have over or underestimated what those perpetuity values are. And that's what would cause a company to be over or undervalued, because that's the point. What would cause Amazon to be worth a lower PE at this point would be a lower G, or a lower spread, or a higher cost of equity. If those things change, then the multiple changes. But if these things don't change, then Amazon's appropriately valued. If these are the real numbers, Amazon is appropriately valued. So a high PE is not a good or a bad. It's just an accurate reflection of the cash flows. And that's the point. If the values are not an accurate reflection of the cash flows, that's when companies are under or overvalued. And the problem with all of this is we're predicting a future. So none of us know what's going to happen in 30 years to Amazon. Amazon doesn't know what's going to happen in 30 years to themselves. But we're making some projections now. So assuming that these projections come true, these would be the values. Right. And so what makes us under or overvalued is when there's disagreement about what those 30 years are going to look like. And somebody like, and this is what's been happening with Tesla, which I'm sure the Tesla team will be addressing, is the analysts are all over the place because no one even knows in the next 5 years how many cars Tesla's going to sell. There's a big discontinuity in the range of what those car sales are going to be. So it's hard to predict. So is Tesla overvalued or undervalued? Well, it depends on how many cars they sell and how much money they make. So if they make what people think, they're not undervalued. They actually might be overvalued, or they might be appropriately valued. So that's the whole idea, is that we're making projections that lead to values. And if we're wrong, then the values change. That's what causes a company to be over or undervalued. But this assignment is assuming these companies are appropriately valued. Why? Why are they trading at premiums or discounts to others? That's why you got to explain the nitty-gritty. Questions? Make sense? All right. Thank you for sharing, Patrick. So why don't we have somebody else share and go through the EV to EBIT multiples?
I'm happy to do that.
Great. Thank you. So tell us why Meta is trading at a premium or discount to, in this case, discount Amazon and Google, EV to EBIT.
Yeah, so Meta's trading at a discount to both of its peers, and primarily its performance with Amazon is due to Amazon's much stronger growth rate and slightly better tax rate. We have the tax rate at 15% here, which is already about 4.5% higher than what the analyst had, but feel like for the long term, that may be a more realistic number. Meta holds a slightly higher ROIC and a higher spread, but yeah, just can't keep up with the growth rate that Amazon is seeing. And comparing Meta to Google.
Please use some numbers. I think you're absolutely right, but back to the following you, use numbers.
Sure. So yeah, Amazon's 10.36 over Meta's 7.26 is a growth rate that just can't be overcome really by even Meta's positive or win in the ROIC, where it's at 21% and Amazon's at 14.5%. Meta's approximately 9.1% spread is significantly better than Amazon's 3.5%, but still not good enough to overcome the growth. Comparing to Google, Meta has a slightly better growth rate than Google at 7.26 versus 6.91. They have a much higher effective tax rate at 20% versus 15.9. A lower ROIC at 21 versus Google's 24, and a slightly higher cost WACC at 10.9 versus 10.7 from Google.
And which of those numbers are leading to the higher multiple for Google?
Can you repeat that?
Which of those numbers that you just stated are leading to the higher multiple for Google?
I think it's the spread primarily that's saving Google in this context.
Primarily, but what else is leading to the higher multiple? Spread's probably the biggest factor, but what else?
Yeah, the tax rate is also
bigger spread, lower tax rate, and third factor.
I guess. I mean, are we like maybe let me ask that question about productivity? We only consider that in
Not yet.
EV to sales.
We're not there yet. This is just on EV to EBIT. There's a third factor that's leading to Google trading at a slightly higher premium.
Lower WACC.
Slightly lower WACC. I don't think it's the primary one. I think you're right about the spread, but the lower WACC does help. And that gives you a higher multiple, all things being equal. Same cash flow, lower WACC, you have a higher multiple. That's what I mean by talking about all the drivers. All right. But otherwise, I think you got the gist of what we're looking for. But again, lesson to all the teams, continue to use numbers and talk about all the drivers.
Should I keep going on EV to sales? Or?
Yeah, you're doing great. So go ahead.
Okay. Yeah, so with EV to sales, I think Meta does a lot better than Amazon here, and only slightly worse than Google. Their performance against Amazon is driven primarily through their margin, and I think the main story that the margin from both Meta and Google sell at 36 and 34 versus Amazon 6 is just a different nature of business. It seems like that Meta and Google are better comparisons with each other than what Amazon's significantly more diverse in terms of its different business model. Meta's productivity, however, they're spending $1.37 for every dollar of sales that they generate, which appears to be that they're trying to invest in new products and new lines of business, where Amazon is at a full dollar cheaper than that. And seemingly able to maintain that. Google, in a similar space to Meta, $1.22 for each dollar of sales generated, and that's causing, that's kind of hindering both of those companies. But just because their margin is so high, that's why they both look a little bit better than Amazon in that front.
Okay. So just to be summarized, Amazon's trading at a lower EV to sales, most important reason because they have the lowest margin. Right.
Yeah.
Meta is trading a little bit lower than Google in EV to sales, and much higher than Amazon, because both Meta and Google have a higher operating margin because they make more when they sell something. But Meta, unfortunately, spends a little bit more to generate that higher margin at a slightly higher cost of capital, at a slightly higher tax rate. And so those sales are worth slightly less, even though it's a higher margin than Google, because they make their NOPAT margin is less than Google when taxes are in there. So the after-tax margin at Meta is actually lower than Google's, and they're spending a little bit more to get that higher tax rate. Productivity 1.37 versus 1.22. That's why the EV to sales for Meta is a little bit lower than Google. Just summarizing. Those are the dots I want you guys to be able to connect. That's what I need to be talking about next week. Questions about any of that?
Yeah, I have a question about these. This is really interesting. The ratio of EV to sales versus EV to EBIT, and how they yield different results with respect to Amazon. And I'm just struggling to understand. I understand all the dots that we've connected and the rationale that have been articulated, but when I try to translate that into stock price, it's weird to me to think that in certain ratios, Amazon's doing so much better, and then other ratios, it's doing substantially worse. And so conceptually, I think I'm missing a piece that ties all this together. Am I making any sense?
Well, can you put whoever just had, was it Chris who had the last, can you put your file back up? Thank you. So remember that what's in parallel to this, because you got to get the same value, is our DCF model. So let's say we have the Amazon DCF model right next to this file. All right. So the question is, how do you get to the DCF value for each of these companies? All right. So let's just think about the DCF model based on what's on the screen. Right. So Amazon's DCF is going to have higher or lower free cash flow every time a dollar is sold than Meta. Like when there's a dollar of sales, who's going to have higher free cash flow? Who's going to have more gross cash flow? Meta or Amazon for the same sales?
Amazon.
For the same sales, Amazon's going to have more gross cash flow, which is profit from the income statement. They both sell $1. How much profit are they going to make?
They both sell $1. So it costs Amazon 37 cents to make $1. It costs Meta $1.37 to make $1.
I'm saying this is a different question. They both have $1 of sales. How much cash is Amazon going to generate?
So Amazon's going to generate 105.
They're going to generate 5 cents. They're going to
5
have 95 cents of cost. They're going to have 5 cents of cash. That's their gross cash flow.
Right.
Right. Meta sells $1. How much gross cash flow are they going to have?
Right. 29 cents.
Okay. So now what's going to happen is Meta's going to put a little bit more of that 29 cents back into the business at Amazon. Okay. So Amazon might take 5 cents and then they're going to put in 1 penny. I'll just make up a number for gross investment. Right. Meta is going to put in 4 pennies. They're going to spend four times as much. I'm generally liberally rounding off. Actually call it 3 times as much. They're going to spend 3 cents on reinvestment. So what's 5 minus 1?
Okay. 4.
And what's 29 minus 3?
25.
So who's
get
going to be
that.
worth more every time they sell $1 of sales, Meta or Amazon? Who's going to have more free cash flow when the sales are sold?
Meta. Okay.
That's why they're at 5 and Amazon's at 2.
I mean, I understand what we just described. It's just what I'm saying is juxtapose the 2 different ratios suggests, one is trading at a higher price relative to its performance than the other. But when you look at the 2
Well,
ratios, they're in
But
conflict with
but why? Then I go back to stop. I want you to understand this. Let's connect a couple dots here because you're probably not the only one that's having these questions. So stop sharing, Chris. So I want to go back to this file. What was this number again? Who is this? That was the ROE for Meta. This is Amazon. Okay. So what's happening? Amazon's growth rate was higher. So even though they make less in every sale, they're going to be growing that a lot faster. So they're going to make less, but they grow it a lot more. Facebook makes more, but they don't grow it as much. So that's why the other multiples that's why Amazon's PE is very high. It's not that they make a lot in every sale. It's because they're going to outgrow Google and Meta based on where they are, right? In terms of percentages. And that gives them a higher multiple. If they didn't have that growth, then that PE, that EV to EBIT wouldn't be higher. Okay. Because basically Google and Meta churn out more cash every time they sell something. It's just math, right? But the difference is Amazon is going to actually take those fewer profits in every sale, but they're going to grow it a whole lot more. So those fewer profits in every sale turn into more dollars over time. Their DCF will be bigger just because they're a bigger company. That's what that extra G does in perpetuity because they're growing at almost 11% a year. And Google and Meta right now are expected to grow 7% a year, and 4% more compound annual growth forever turns into a heck of a lot more cash. That's why those EV to EBITs are so high. It's not that they make a lot in every sale. It's because they grow it so fast. They grow that spread. Okay. Does that somewhat make sense?
It does. I mean, I'm struggling with, well, why isn't the enterprise value on Amazon less? But I mean, I understand all the, the 2 different formulas and the ratios. Again, there seems to me to be incompatibility between, Amazon having half the EV to sales of Meta, but then almost triple the EV to EBIT. I mean, so I don't know. It's just, I'm struggling with it. I guess I have to sit with it longer.
Yeah. But again, I'll just repeat what you're just saying. I'll put it into layman's terms. Amazon makes less in every sale, but Amazon's going to have a whole lot more sales. And when you do that math, the more sales, that scale is actually going to lead to more value. They're going to have a bigger DCF just because they're bigger.
So that's then maybe the question I'm really asking is maybe EV to sales is an unimportant ratio relative to EV to EBIT. Is that what I'm really getting at?
Well, what I'm saying is we do all three multiples, but in an industry, the industry will tend to settle on one of them as the primary driver. And it might change over time. Just think about it conceptually. Like, why would we use EV to sales? Well, one of the reasons we would use EV to sales, because all of them are supposedly predictors of free cash flow. So which of those three, EV to revenue, PE, or EV to EBIT, are the better predictors of free cash flow? Because that's what we're trying to do here. We're trying to figure out operating value, which is based on free cash flow. Which of those three multiples are better predictors? Do you think EV to revenue is a better predictor of free cash flow? Or do you think EV to EBIT is a better predictor of free cash flow?
I mean, I would think EV to EBIT.
I would agree with you. Because what the problem with EV to revenue is it doesn't take into account cost or reinvestment. So therefore, EV to sales is probably not your best predictor of free cash flow. So you might say, well, why would we use EV to revenue to value a company? Well, let's talk about an early stage company that doesn't have any profits. I'm a company that doesn't have any EBIT. How do I value that company? Well, I might value them as a multiple of sales, right? Because it's more practical, right? Now, eventually, when they become more of a sustained business model, because I'm trying to eventually get to the free cash flow, I might switch to an EV to EBIT multiple for a more established business. And that's what you see for more established businesses. EV to EBITDA, EV to EBIT are what are used. For less established businesses, EV to revenue. Not saying we can't do all these multiples in every company, but what's going to be the key driver? Which one best explains the free cash flow? Now, for some businesses, they still use PE, right? My knock on PE is PE is fine so long as the capital structures are similar, because capital structures can distort PEs. And the other thing is these non-operating gains and losses can distort PEs because you're dealing with accounting. So as long as the company's got a clean P&L and there's not huge differences in capital structures, PEs are fine. They're also pretty predictive of free cash flow. And EV to EBIT and PE, pick one that's their poison. But if you see a company that's been dealing with a lot of accounting issues or one-time charges, PEs can be really distortive of long-term values. And that's why the enterprise value multiple is more suited for that. But it doesn't mean you can't do a PE in a company. You might just get a crazy number that doesn't make any sense. So that's the other thing. Like we're kind of doing all the multiples and trying to explain it. Sometimes, they might be less valuable to where we are. But I'll give you an example. I'm not a person who does valuations, and my accountant's like, look, Joe, there's another small business who got an offer for his small business, is trying to figure out, is it a fair value? And they're like, can you do a free valuation for me? And I was like, well, I'm not in that business and I don't want to like lock myself into an evaluation, but I'll tell you, like, back of the envelope, if I were doing it, what you could do yourself, which is, take the total value of the business, take trailing 12 months of sales, take trailing 12 months of EBIT and do a multiple, and then take the current forecasted 12 months of sales and 12 months of EBIT and multiply by those multiples. And there you go. Like, you can actually figure out based on historical values, if a run rate is going to happen, what a company might be worth. Well, that's no different than doing a DCF, right? I'm just doing the shortcut of the DCF, but the multiples would say, and then you could say, okay, well, like, let's say this company's trading an EV of sales of 50 cents. And let's say this company's trading at a EV to EBIT of 10. Like, which of those two is more predictive when they grow of what those DCFs would be, right? And you might say that, EV to sales is more predictive given the stage of the company. Or you might say EV to EBIT is more predictive given the stage of the company. So then you could make some nuanced adjustments, but that's how you'd use the same analysis to value a private company. And you might even look at what other peers are doing. Just compare that multiples to what peer multiples are. So again, long way of answering, or at least discussing your question, because I think it's a very important question. Like, in this class, we're doing all the multiples, right? But in terms of how they tie together, the point is they have to tie together because they're all based on the same DCF. It's one value for Amazon, regardless of the multiple. And what you should understand by doing this analysis is Amazon is trading at a higher value, higher multiple, because their G is higher. That high G is leading to a high multiple. right? That's the one thing that came out across Amazon for your PE and your EV to EBIT multiples. Amazon, when they sell something, makes less than Meta and Google. That should have been the big headline for Amazon coming out of your EV to sales analysis. So they make less, but their growth leads to a higher value. Those are why I can make those two comments. That's the data that we've been looking at tonight.
That's helpful. Thanks. I appreciate that.
Other questions, comments about any of this? Because this is what you guys had to be doing this weekend leading into
Professor, is
But
it fair to say, like Amazon, they aren't really peers for it because these two are not really great comparables, as we mentioned, because they're like, I'm not sure exactly what Amazon's, percentages are in terms of core business and non-core business, but their core business is surely completely different to what these two do.
Well,
and this is why their margins are completely.
yeah, and back to your point, like if I go back and even looking at historical data as an example, and I look at the 10K, let's say I don't have access to Bloomberg and I just have the 10K of these companies. Like this is the data from the 10K in 2022 for Amazon that breaks out their $500 billion worth of revenue. Okay. Now think about Meta and think about Google and tell me which one of these lines up. Of the 500 billion of revenue, how much of that is similar to what Google and Meta do in 2022?
Maybe advertising, subscription, maybe.
Okay, so that's probably this, maybe that. So we're talking 70 billion, 72 billion out of 513 is truly comparable. That's the point I made 2 weeks ago. We started the lecture and I said, this is the hardest part of doing pure analysis, comp analysis in the real world, because finding peers is actually not so easy. So I'm not saying that, I mean, even Meta and Google look at Amazon. I can tell you as somebody who works at Google, they look at Amazon, right? Because they're worried about this. Right? This is their direct competitor out there, right? But Google doesn't do the rest of this stuff. So that's the problem, is that it is a little bit of an apple and an orange. And that's the same thing. I'm a sell side analyst. If I'm covering online, I'm covering these companies in a similar market. That's why I picked them. Because you look at the default peer list, that's who they define as their peers. But these are not exactly pure play comparables. And I'm just telling you, in the real world, it's really hard now to get pure play competitors. Think about the team that's doing Tesla this week, right? I gave them Ford and BMW. Are they truly peers? I mean, they sell cars.
So they're pretty different, especially if you consider that Ford probably has a big financing business. Tesla may or may not, but Tesla also has solar panels, and also the electric space is completely different from Ford and BMW's traditional combustion engine space, even if they do have a percentage that's growing in the EV space.
Thank you. You exactly answered the question. Yet, if you simplify it, that's how people are going to look at them. They're going to look at those three companies. Ford has, as you just said, Ford Motor Credit. Tesla doesn't have the corresponding credit business. And so right there is a gigantic difference between those two companies. Yet, you're going to see those two companies' multiples put side by side. And that's what the Tesla team is going to be doing next week, 1 week from today. That's why analysts get lazy and they actually encourage companies with like, you're going to break up into pieces or spin somebody off. It's another reason why they applaud it. It makes their lives easier. Because when I take a conglomerate, which does like 6 different things, and I break them into 6 individual companies that are more pure plays, makes the analyst's life a lot easier. Conglomerates are very tough to value for that reason, from a comparable standpoint. Oz?
So like when you're doing analysis, can you not do that, like break them up? Like here, what you were showing 3 for 6 different businesses, right, or sectors. So like, let's say,
How do you break out, just I'm asking you, from a multiple analysis standpoint, how do you break out Amazon Web Services from Amazon?
like, if you have like projection for that, just that business, like then you can do like a DCF for just that section of it.
All right, so there is a projection for AWS, which is, where is it? There it is, AWS. Here's a projection for AWS revenue, and slightly below that is an AWS EBIT. So I got a growth rate, I got a revenue, and I got an EBIT for AWS. So tell me what else I would do. If I want to do a multiple analysis of Amazon Web Services versus the cloud business of Microsoft, how do I do that comparison of those multiples? Azure, AWS versus Azure multiple analysis.
So you'll have to figure out a WACC tax rate that you'll be paying. And then maybe growth rate from this.
So what you're basically saying, and I agree with you, is it's called the sum of the parts valuation, talked about in the book, because you can add DCFs together. So if you really think about Amazon, and you can kind of see it here, like they're an online business that's going to grow to $300 billion at a certain margin, DCF it. They're an ad business that's going to grow to 72 billion at a certain margin, DCF it. They're an AWS business, it's going to grow to 848 billion at a certain volume and margin, DCF it. Add those three businesses together, and then you get Amazon's total value. So with a DCF, you can kind of back into a value for each of those businesses. But the multiple gets harder, because then the question is, if they were independent publicly traded companies, what would their multiples be? Well, based on your assumed DCF, you can then assume a multiple from that DCF and then do a comparison. But how many assumptions did we just make when we got to that comparison? Versus if I just did Amazon against Microsoft as a company, I have real world data I can point to tonight. There's a real that people are paid today. There's a real EV to EBIT that people paid today in the real world. I don't have to make any assumptions on that. So that's the thing. Like when you have real prices, it makes the evaluation easier. When you have to create synthetic prices based on a bunch of assumptions, how good were your assumptions? And it just becomes harder to do. I'm not saying people can't do it, and that's exactly the way you could try to do it. But then just remember that you're like 10 assumptions down the path when you're making those comparisons before you even start to make those comparison assumptions. That's why people don't do that. They'll do DCFs, but they don't do synthetic multiples that way. They'll use real world multiples as proxies, just because they're more based on current cash flows and current prices. Good points. Any other questions, comments about this? All right, so want to mention a few scenarios as we're going through and doing these analysis. And this is specific to multiples. Just a few scenarios that you're probably going to come up with or come up against. So let me grab this file and share it. All right, so for purposes of right now, don't worry about these other companies. Hide. This is generic. All right. So a few scenarios that are going to come up with multiples, right? So here's what we do, right? what we've done as a process is when we look at multiples, and I'm gonna use the PE as an example here, we basically have worked backwards to say, okay, if we know the real world PE and we know the key value driver equation, start with the expected growth, second forward year, start with the expected return, start with the current cost of equity, current spread, and based on expected return over time, and solve for the G. Okay, and then we use the solver to basically get those G's to match. Okay, so that's one approach. And the reason why we're taking this approach, as I said last week, is because it's easier to forecast this than to forecast that. Okay. However, let's say that we were forecasting Royal Caribbean Cruise Lines during the pandemic. And they were trading at a high PE in the real world. But the problem is that during the pandemic, if you tried to grow a negative spread, it made the PE worse and worse and worse. So then the question becomes, how do you value a company like Royal Caribbean's, and I'm just directly making up data, that has a pretty high PE when they have a negative spread? What's the approach here that we would need to take? If I had to do a multiple analysis and I'm dealing with a company that has a negative spread, which can't lead to a positive high PE, yet they're trading at a high PE, how can I justify it? How can I come up with a reasonable answer for their multiple?
Negative growth.
Okay, so I could put in negative growth. Negative 5%. That starts to move my G. But think about, what does a negative G really mean? It means their net income is basically going to get lower and lower and lower by 5% a year forever. The cash flow is going to just keep going down by 5%. That's what negative G technically means. So yes, mathematically, we can probably make the math eventually work. But does that actually make logical sense about the way the cash flows are really going to occur? And I'll give you a hint, no, it does not. So just because we can solve it with a negative G, that's actually probably not the better, that's not the way the market's going to be looking at this. This isn't what you're going to see in a spreadsheet at JP Morgan. So what would we have to do in this situation? Because putting in a negative G doesn't make logical sense.
Could we take the growth rate from the DCF analysis, plug it in, and then solve for an expected return on equity?
Yes. So one of two ways. And I said I don't like to do this because the G is very sensitive, but we could either take a G from our DCF, or we could just assume a G and say, look, Royal Caribbean is probably going to have a G closer to the market growth rate long term. And then based on this G of 3%, or based on the G that we've modeled out in the DCF over time when they recover, then we solve for a spread. So when we do our goal seek, instead of goal seeking the G, we basically goal seek the ROE. And he gave one of the ways, thank you for, was that John? I think John gave one way to do it.
Yes, it was.
Yeah, thanks. John gave one way to do it, which is think about what the spread would be when they recover, and then basically try and do it that way. Or we could try and use the approach John suggested, which is put in a growth and then solve for what that spread is when they recover that would lead to that multiple. Okay. And so again, a second approach, which is the first one I started to mention there, is go back and look historically. What was the spread before the pandemic? And will they achieve that business model again? And is that representative of their future? And put that in there and then solve for a G. So that's the point. Like, we would have to make a couple of assumptions and be very clear about our assumptions when we're doing this, that would actually lead and justify a DCF. But I think underlying all of this is why it's helpful to do both of them together. it's helpful to do a DCF and a multiples as opposed to one versus the other. Because not only do you triangulate them, but technically they're valuing the same thing. And you should have a good story with whatever approach you come in. That's why the assumptions are important with what you do something. But the worst of the answer is would have just been to solve for a negative G. Because if you think about the cash flows in a DCF, it just wouldn't make sense. By the way, when would it be appropriate to have a negative G?
In a deflationary economy.
That would be one point. When else would it be appropriate at a company level to have a negative G? What did I just say a negative G in a perpetuity means? Adam?
If you forecasted that their net income would be decreasing over time, so like Kodak or a company like that.
Yeah, a company that's being disrupted and is going to be struggling over time. Or I mentioned a pharmaceutical company that's making a huge amount of money on a patent that's peaked, and now over time, because the patent is expired, it's going to be generating less revenue over time. Pfizer, by the way, is going through that now with their revenue. They got a dramatic, and you can see it here. Go back to Bloomberg. Pfizer, if you look at their revenue, last year, Pfizer's revenue was 100 billion. This year it's 66 billion. Why?
The vaccine.
Yeah, they had the COVID vaccine, and they also have what's the pills?
Lovid.
The COVID pills.
Paxlovid.
Paxlovid, thank you. Which people aren't taking as much. Right. So that's the point. They had almost like a one-time hit post-pandemic, as the pandemic is starting to hopefully wind down, although there are bad things about the new COVID strain. But in any event, as the pandemic's been winding down, people aren't getting the vaccine as much. They're going to probably have a negative G versus last year's earnings. And it's not that Pfizer's going away. It's just when you go from 100 billion and all the cash flow associated with that, as you can see it down here, look at the free cash flow for Pfizer. Last year's 26 billion. It's going to be lower because they're not going to get that one-time blip of free cash flow. So Pfizer's going to have a negative G in their valuation today, and it's nothing against Pfizer. So just something to be aware of, that you might actually see one. And so sometimes it could mean that the company's going under, and sometimes it means that the company is just peaked and the company is expecting worse performance over time, right? And so that's the other thing. When you're dealing with these one-time things or cyclical businesses, you got to be very careful about the multiple analysis, because you have to think about it in perpetuity. You can't just think about it as a point in time. And if that point in time is a blip, then your multiple analysis is going to be distorted. Or if you're thinking about a cyclical business, if you're at the top of the cycle or bottom of the cycle, it could distort your multiple analysis, right? Because the future doesn't look like today, right? Because remember, we're dealing with perpetuities, right? And that's just a few important things to remember as you're doing these analyses. Questions, comments, concerns, crippling fears?
It seems like that growth rates, I mean, we keep saying that it is super sensitive, but with Pfizer's example, right, like over the long term, we do expect them to remain a company that I mean, probably grows a little bit. Is this the fact that they have a massive spike like this? Is it basically forcing us to almost put them into sort of a negative growth projection, instead of saying, like, realistically over time they would close that gap and get back to that 100 mark? And in that case, is it justifiable to plug in some other numbers rather than using a growth that balances our multiple?
So here's what I'm going to do. I like your question. I think it's a great question. So rather than doing this conceptually, I am taking a couple of screenshots of Pfizer. And I'm gonna put you into your teams, ad hoc teams for a few minutes. And I want you to come up with a multiple for Pfizer. Come up with the 3 multiples for Pfizer using our process and see if they make sense. And we explain Pfizer's value. We just do Pfizer all by itself. Pfizer Mac. Thank you, Pfizer, for giving tax rate guidance. All right, so I am going to put into the files folder for week 6. I'm going to be moving the BMW data out, but I'm going to put you into your teams, random teams, for like 10 minutes. And I am putting into that folder data for Pfizer, which will have their the WAC, tax rate, and their the earnings estimates. The data is there, so it is here. In this folder. Those are the 4 files. So come up with a multiple that makes sense for Pfizer. You tell me what it should be. And we'll come back and talk about this on the other side. And actually, tell you what, just to make it fun, I'm going to put in the Lilly data. So we'll compare Pfizer to Lilly, just so we have a comp. Trading premium or discount. Let's just look at these companies. So this is the Lilly guidance. This is the Lilly WAC. Sorry, just grabbing the data in real time. Apologize for the delay. So back to the data here. In this folder, data for Lilly, data for Pfizer, do a multiple analysis comparing those 2 companies to the files folder. Ignore the Tesla data. I'll move it out while you guys are in your rooms. I'll give you 10 minutes to put the spreadsheets together and then be prepared to talk about premium or discount and how you came up with multiples. It'll be good practice. All right. So you didn't do an EIC on these companies, but I think some of the teams I was listening in the background were picking up on some of the context for the two multiples that you were creating. Just start with this, what you were picking up on. Lilly, over the next 4 or 5 years, as a proxy for the long term, is expected to pretty much double in size. Last year, they had 28 billion in sales. By 2026, almost $54 billion in sales. And one of the reasons is because of a drug called Mounjaro. It's a weight loss drug, kind of like Ozempic. So it's their version of Ozempic. And essentially, as weight loss as an industry is expected to grow to $100 billion annually, up from 10 billion annually 2 years ago, which is freaking out the entire insurance industry. Nobody wants to cover the extra 90 billion a year in weight loss drug sales. Lilly has one of the two drugs that is going to be a leader in this space. So that's one thing that's going on. And for Pfizer, what we were talking about in context is that their COVID-19 vaccine did almost $38 billion worth of sales last year. It's still going, but it's going to drop to about 9 billion of sales by 2026. And that's the primary reason why they're going from 100 billion, Paxlovid, again, 19 billion of sales to 5 billion of sales, from 100 billion of sales to 68 billion, say, over the next 5 years, which is kind of distorting their perpetuities. So those are just two contexts going into the data that you just created.
I had a question.
Yeah.
So right at the end, our group started talking about as like a reasoning for the vastly different numbers.
Yep.
Does the pharmaceutical industry experience a type of like cyclical nature due to the patents on the drugs?
Yes.
Okay. Yeah, because we weren't sure.
Well, yes and no. I'll say the ones that have kind of the mega drugs, yes. If you have like a bunch of similar sized drugs in your portfolio, less so. So, translation, if you're Johnson & Johnson, which doesn't have mega drugs, but tends to have a bunch of consumer drugs that people buy pretty regularly, Band-Aids, whatever, or just, drugs that are mostly off patent or, in mature stage, then they're kind of consistent over time. If you're a company like a Pfizer, which has a one shot, or a Merck, which increasingly with Keytruda is going to look like Pfizer in a couple of years, as I mentioned in previous class, or if you're, Lilly, which eventually is going to have the wave of the weight loss drug, which is going to bust, then there is going to be sort of a change in those multiples over the cycle. And as somebody just put in the text, patent lives can be 17 to 20 years. But the point about the patent is it usually takes you 10 years before you launch the drug. So most pharmaceuticals get 7 to 10 years of patent protection for their drugs because you actually have to do the patent when you start working on the molecule. And that's in very early stage R&D. So life cycles for drugs on market, once they've actually gone through clinical trials, you're over half the patent life is gone when you actually start generating revenue. And so, but that's the boom and bust cycle. So they want to generate as much revenue as they can during that typical 5 to 10 year period of patent life once they are approved. That's the game for some of the companies, because as you see, once that patent expires, in the case of an AbbVie, which I showed you before, or eventually in Merck, or once that one off in the case of Pfizer going after the vaccine, then your situation looks dramatically different at the end of that period. So that is somewhat unique to the pharmaceutical industry. So really good point, call out that your team made at the end there. All right, so you guys show me, what'd you come up with for the multiples and the explanation for the two companies? And I heard one of the teams say that they seem pretty dramatic. It was group 2 or 3 I was listening to.
Yeah, so Lilly has a spread. Looking at
Why don't you share the screen so we can see what you got?
Yeah.
Were you the team that talked about how dramatic the difference was?
Probably.
Okay, well, maybe there's a couple teams, but go ahead.
Um, yeah, so just looking at the spread between comparing both, like Lily's at 64.9. So it just dramatically compared to 6.9. So that spread, that difference in spread, as well as the higher growth at 6.2 for Lilly versus a negative 2% for Pfizer, contributes to a much higher PE valuation, as well as they also have a slightly lower cost of equity at 8.3 versus 8.4.
Yeah.
So obviously in perpetuity, negative growth is what we were just talking right before the breakout room. So we kind of made a copy and put, plugged in a 3% just to, quit. We didn't have like historical from your screenshots, but maybe that's what this would yield.
Well, but if you follow that logic, let's say we did take the 3% growth, what would you have to do to get down to a PE of 10.58?
Reduced one of these two.
You'd have to reduce the spread.
Right.
So in this case of negative G, would that make sense? Meaning, do you think Pfizer is, given the pharmaceutical industry averages, 20% ROICs as a group, and they've been doing that for a while. Do you think that Pfizer's spread is going to go way down over time?
Maybe not.
So in this case, the negative G actually might make more sense in explaining what's happening to Pfizer. Because if you went with the approach of trying to put in a long-term G, you'd have to explain why Pfizer spread would get so much worse over time. And that would be harder to explain when you start to put out the assumptions. So why might it actually be okay to have a negative G for Pfizer?
Because the conditions for the global pandemic are hopefully not going to be replicated.
Yeah. And that's, so it's just that one-time blip. And it's just saying that because we're dealing with perpetuity, the future is just going to be a little bit worse than the present for them. So they're still going to have decent spreads. And because don't get me wrong, 15% is still not a bad return, but nonetheless, that actually would justify a negative G. So unfortunately, for those of you trying to write notes on all of this, there's not one right answer where it always works the same way every time. So sometimes you have to kind of think about what you're doing with your valuations. David?
So I was just wondering, how do we justify the fact that we would assume maybe that they would start growing again after maybe 5 years?
Well, it just goes back to the nature of their business, meaning in the pharmaceutical industry, that's one of the reasons why we look at pipelines. Like, do they have a pipeline of new drugs? Probably we'd find out the answer would be yes. And they have a history over the last 30 years of constantly, innovation and driving these returns. So it's really just saying that as a pharmaceutical company, if they can continue cranking out some new drugs under patent and finding ways to monetize their existing drugs, they can continue it for a while. But that gets back to competitive advantage. Now, maybe I'm dealing with one company who doesn't have a portfolio and it's just, they're kind of like a one drug company and the drug's off patent, they got nowhere to go. But if you start digging deeper in your analysis on a company like a Pfizer, you see that they're in, I can show it to you even here. You would look and notice that, hey, Pfizer is a company that's got, multiple, like, way of saying this, they got primary care drugs, they got specialty care drugs, they got oncology drugs, they got what else? The immunotherapy was in here to find it. But the point is, it's not like all these drugs are going to go away. And because they're in these different classes, they're spending a lot of money on future oncology drugs. So you would assume some level of sustainability in the long term, but you're proxying it out when you do this type of analysis. Versus if I were just one company that only had Ibrance, for example, that was their only drug, they were a small biotech, I may or may not want to give them credit for building a portfolio. So again, that's why we do EICs, right? Because it's very helpful to understand the context of the company and the industry that we're doing the DCF on. If that makes sense.
Yeah, it does. I guess I'm thinking, do we, in our own heads, discount their multiple, or are we just going to make sure we redo the multiple in a couple years, you know, when the landscape's changed?
See, now you're starting to think like a sell side analyst. So I think exactly. And that's why, for example, when somebody asked earlier today, like, what would cause, I'm going to paraphrase, they said, why would a company be overvalued? I'll use different words. What would cause a multiple to change? Our view of that future, the circumstances change. Therefore, our assumptions change. Therefore, the key value drivers change. Therefore, the multiples change. That's why the analysts, in a way, look for these data calls. Every 3 months, Pfizer's giving them a new data point. So when they get new data points, they're always updating their models because they're getting new information. Or they're checking and they're seeing, hey, Pfizer had this very promising drug that was in stage 3, and suddenly a bunch of people died. So all this revenue that we thought they're going to get from this drug, they're not getting anymore, because there's no way that the FDA is going to now approve it because it's just failing the clinical trials. So, those things are stuff you just have to pay attention to. That's why, to some degree, what we're doing is dynamic. I mean, even in the presentations you're doing next week, I mean, from the time I gave you the data a week ago to next week, things are going on. I mean, we're in earnings seasons, and a couple companies reported earnings after I probably gave you the data. And that's going to have a point of view. As a matter of fact, Tesla was in the news in China this week pretty heavily on what they're doing over there. So I would assume that the Tesla team is paying attention to that, because it is affecting their stock price and therefore their valuation. All right, how about somebody else pull up? Let's go back to the spreadsheet that you guys just did. Let's get, I'll pick on a team this time. Why don't we get group 3? So Ashish, Chris, David, Paul.
I think Gabby was our team that we just shared.
Yeah, I was part of that team.
Okay, great. I'll pick on a different team. Let's go with team 4. Isaiah, Joseph, Julian, Maz, William.
Okay, let me share.
So why is, I assume we got some more numbers, why is Lily's PE so much higher? Go back to the other chat.
Oh, sorry.
I want you guys to do the analysis. Why is the PE so much higher at Lilly?
Well, 2 reasons. The difference in the cost of equity is not making much difference, but their spread is huge compared to Pfizer, on the tune of 73 versus 15, and the difference in those. But they're also growing positively, not negatively. So it's those 2 factors. Their growth rate is much higher, and their spread is really large compared to Pfizer.
Yeah, this one's pretty straightforward. So go to the next tab. So tell me about, because I think you're going to say similar things for EV to EBIT. Tell me about EV to sales. Why is the EV to sales so much higher for Lilly than Pfizer?
Because Lilly's a lot more productive. I mean, their operating margin is relatively comparable, but they're a lot more productive. So for every dollar of sales, for every, how do I say it? Every dollar of sales, they've got 65 cents invested, whereas for Pfizer, it's taking them $2.28 to invest to make $1 of sales.
Yeah. So therefore, their free cash flow is going to be higher per dollar of sales because of that. And therefore, we're paying a lot more for their sales. We're paying almost $14 every time Lilly sells something versus $3 every time Pfizer sells something. Does everybody see that? Can everybody connect that dot? And again, the EV to EBIT, pretty straightforward in terms of the same reasons as EV to, as the PE. That's why I didn't ask them to do it. All right, questions about any of this? How to put the data, what to put in, where to put it, where you got it from, what it means.
That expected OP ROIC cell B7, how'd you guys get 12?
Yeah, I think we had a limit that our RIC had to be less than our ROE. So we got a lot higher number when we looked at the whatever it came from. We got a lot higher number, but we had to limit it to be less than our return on equity, which I think was given as expected of 15% or so. Yeah.
Okay.
I think we picked 12 because of their capital structure. It was like 75-25.
Thank you for asking that question, because that's something you're gonna have to go one of those two ways. Meaning the ROE and the ROIC in perpetuity have to be simpatico. So the answer he gave made a lot of sense, meaning because the ROE seemed to be the one he was going with, they had to limit their ROIC. If you really believe that the operating ROIC last year, which is what I gave you in the spreads, was indicative of their perpetuity, then you would have had to really raise that PE ROIC or ROE much, much higher, because they'd have to be in sync. Because if you had a 40 or 50% ROIC, then you'd have to have like a 50 or 60% ROE.
Got it.
By the way, if they had done that on the PE side and they'd made their ROE 50%, what would have happened to the G to get to a PE of whatever it was, 12 or 14? Like this team, go to the PE tab. What happens if Pfizer's ROE is put in 50%? How do you get to the PE? What would you have to do to the G?
Their growth, it would have to be, I'm thinking it would have to be less negative.
Well, put in -1. Does it go closer?
Yeah.
There you go. So you'd have less negative G. So you could actually make an argument for that scenario, but that would be the point. Like you'd have to think through, all right, why am I doing this? And what does this practically mean? This is basically saying that they're not going to shrink as much going forward. Given that they went from 100 billion to 60 billion and the revenue and cash flows and profits are in sync, are they not shrinking at all, which is the -1% tends to suggest, versus shrinking more, which is the -2 suggests. So given that, if you played that scenario out, you probably more likely came up with what they actually did, which is the lower ROE versus the much higher ROE, which means the lower ROIC long-term versus the higher ROIC. All right. And then it goes back to the nature of the industry. If you have a drug under patent, you're getting huge revenue and huge profits relative to your investment. That's going to be lower productivity. If you lose your patent productivity, then you're going to get less sales relative to your investment, which means you're going to have more invested capital to sales numbers. That's what's happening to Pfizer. Like the reason why their invested capital sales is higher than Lilly is benefiting from a couple of drugs that are just launching. They're going to be under heavy patent. So they don't have to spend a lot of money to get a lot of sales. Pfizer had a lot of sales. Now they don't have the sales for the investments they made. Their productivity is worsening. That's why it's higher than Lilly's on a go-forward basis, because it is relative to sales as well. All right. Thank you guys for doing this extra work. I know we should have taken a break a while back. Any final questions here? Any final questions about your group projects? Any final questions about the final exam that's due next week?
Can you give us all A's?
I think the school would penalize me if I did that. So that would not be appropriate.
We won't tell anybody, we promise.
I actually, the grades are the grade. That's the way I look at it. Yes, attitude too.
Yes, I wanted to ask, is there a limit on the number of slides we're supposed to have?
You have 20 minutes. I think the real limit is 20 minutes. You have 20 minutes to present everything. So here's what I will do. I will also grab a presentation that's been done in previous semesters, similar class, just as a template. You could use it to say what was, what did they do? And you can use that as a guide. Not saying you have to exactly copy it, but at least give you a reference point when you're putting your slides together. But the most important thing is make sure you have the data to answer all the questions in what is required. So the appropriate amount of slides for that is the minimum. You want to add more data? Great. Just remember you got 20 minutes. You got to cover all 4 sections. Any other questions?
Professor, quick question. Could you remind us how you get the cost of equity figure for the multiple on the PE tab? I had one slightly different.
The simplest way to do it, if you don't have any issues, is I'm giving you screenshots called the WAC screenshot. And on the WAC screenshot is the WAC is here, the cost of equity is there.
Gotcha. Okay.
And by the way, we didn't have a situation where this occurred, but remember that, sometimes we're dealing with real world data. The WAC doesn't make sense. It can happen. And you might have to choose to make an assumption that you adjust the WAC as you're doing your multiple analysis.
When does the final open in Canvas?
Sometime tomorrow. I have to load it in. As soon as I load it, it'll make it available. And you'll have, like I said, between tomorrow and next Wednesday to do it. If I get it done tonight, I'll try and load it tonight. But I'm going to be working on sending up all the data that you guys need and then uploading that.
And sorry, not to ask a question that may have already been answered. But once we start the exam, we have 4 hours to do it.
I'm going to put a 4-hour timer because I want you to do it all at once. So I don't want you to go look at it, go to sleep, come back later, answer a question, come back later. Take the exam. It's an exam. Pick a time when you're ready to take it. Individual, but open book.
Do you have to use Excel spreadsheet or like a
It's multiple
DCF?
choice, so I'm probably not going to make you do a DCF and a multiple choice exam. But I might ask you if there was a DCF number, what it might tell you to answer a question based on that.
Okay.
Here's a company that has a higher multiple. What would that mean? A, B, C, D, E. But yeah, the exam will not require math. The exam will be a multiple choice exam. Focus more on the theory. The math is in your group projects. All right. Well, on that note, thanks everybody. Again, I'll be available if you have any questions. I know one team wanted to stick around after class and talk about something. So if that team wants to stick around, otherwise we'll let everybody else go. And I will post the recording when it processes a little bit later tonight, as well as sending more data for each of the teams, which I'll be working on as soon as this class ends. But otherwise, good luck and look forward to hearing your presentations next week.
Thank you.
Thank you.
Thank you.
Thank you.